Today we'll be taking a look through Social Capital's 2019 annual letter. First, for some context, Social Capital was founded in 2011 by former Facebook executive Chamath Palihapitiya, whose net worth is not $1.2 billion.
Your net worth is $1.2 billion.
Look, I got exceptionally lucky, okay? Am I proud of it? Yeah. Is that number inaccurate? Yeah, it's actually much, much better than that, okay? I have nothing to be ashamed of, okay? So, but none of that matters. That's my whole point. It doesn't matter. Don't label me by that number, which is inaccurate to the downside by many multiples.
The venture fund has invested in a range of companies over the years, perhaps most notably of which was their investment in Slack. In mid-2018, they closed through outside capital and became a technology holding company. According to Chamath, this decision was made in order to take a more long-term approach and avoid the short-term fee generation game that is prevalent within the venture capital industry.
The incentives in this industry are the most out of whack they've ever been. It's a bit of a charade.
Well, it's an almost incomprehensible series of coincidences,
Yes.
if you will.
I thought Ricky was dead on summing it up, as she always is. When she said it's maddening, number one, it's very suspicious. And when she also said all these things can happen, but in one place, time after time, I don't know. A lot of questions there.
So my point is, I looked at our portfolio. We have some incredible businesses. We have things that are really meaningful in the world. We have both. And I'm like, it's time to take my chips off the table. Sorry, ciao. You know? So, and I would rather sit there and wait with an enormous balance sheet of capital, find the really, really good companies that need the money, and then also wait for some of this air to get out of the balloon.
As always, Chamath provides some very interesting insights in this letter, so let's get started. First off, Chamath makes the argument that we are currently in the later stages of a modern Gilded Age. The Gilded Age was an era of rapid economic growth in the United States from the 1870s to around 1900. During this period, there was rapid economic growth, wage growth, immigration, and expansion of social programs. The major industry of growth was the railroads, and a class division started to emerge with the 1% owning more than 25% of all property and the bottom 50% owning less than 4%. Chamath argues that there are many similarities between the Gilded Age and today, both economic and societal. But what came of the Gilded Age? Well, the excesses and lopsided nature of the Gilded Age ushered in the Progressive Era, which was a period of widespread social activism and political reform across the United States that spanned the 1890s to the 1920s. As well as addressing the problems caused by industrialization, urbanization, immigration, and political corruption, the progressive movement also sought regulation of monopolies, trust busting, and corporations through antitrust laws. Of course, Chamath is not the only high-profile investor to highlight the importance of looking to the past for lessons.
And then say, how did they occur in the past in order to gain a perspective? Because what you're bringing to the table right now is the notion of the same things happening over and over again and the lessons from history. And that's the exercise. Everything is another one of those that happens over and over again.
Chamath highlights the rise of populism and the increasingly loud calls for change. Therefore, in this context, the last few years seem very much akin to the beginning of the end of our modern Gilded Age and the beginning of a new progressive era.
What's going to happen is a bunch of turbulent manifestations of frustration, aka populism, that then eventually calm itself down and it'll factor itself into policy. This is why these big companies will get regulated. They will absolutely get broken up. This is not 1999 Microsoft DOJ. This is basically the turn of the century Gilded Age.
The question is, which companies will be broken up and when?
In order of probability, Facebook first, then Google, then I think all the other ones are a little bit more delayed. It's going to be those, and it's probably in the next, sort of like 5 to 10 year time frame. Facebook is the most obvious one just because they touch many politicians where they live, eat, breathe, and get paid.
Drawn on the comparison with the Gilded Age, Chamath states that the only way to effectively rein in big tech is via trust busting. Chamath also highlights the importance of making sure that big tech doesn't find a way of helping to write the regulations such that they can promote and cement their monopoly. Moreover, Chamath describes the value created by big tech as an increasingly decaying function, whereas the need for true progress is increasing. The combined R&D budgets of big tech total more than $600 billion in the last decade. Big tech promised to change the world and eradicate its evils, but it's clear that it isn't happening, as they seem more focused on protecting their monopolies than advancing humanity. For some context, the cost of the entire Apollo program was $25 billion, the equivalent of around $150 billion today. However, big tech spent $75 billion on R&D in 2018 alone. Thank you very much for hitting the like button just now, by the way.
Categorically false, and for which you have no evidence whatsoever. Wild conjecture on your part.
Chamath then gives his take on the market, stating that central banks have exhausted their ability to meaningfully manage inflation in either direction, but that doesn't mean that stock prices won't continue to go higher via unnecessarily cutting rates and flooding markets with money. Our simple framework is this. As money gets cheaper, the credit markets continue to expand because CEOs become motivated to artificially boost earnings per share. They do this by buying back stock, seek bad acquisitions, make poor capital allocation decisions, or avoid taxes, all enabled by borrowing massive amounts of essentially free money. It shouldn't surprise you to know that these decisions also result in ever-increasing CEO pay. Basically, earnings per share means the net profit divided by the number of outstanding shares. When a company buys back their own stock, the number of outstanding shares decreases, therefore the earnings per share increases. CEOs often have bonuses that are tied to hitting a certain EPS or earnings per share. Therefore, it's little wonder that corporations have been the dominant source of demand for equities, as they have a clear incentive to buy back stock. As a wise man once said, show me the incentive and I will show you the outcome. Chamath has previously been vocal in his criticism of VCs and the need for rapid growth above all else.
I would love to grow and find a business that can be there growing 20 to 25% a year for the next 15 years. That violates all the mechanics and all the gymnastics within a venture fund. It's like grow at 400 because we know 400 eventually decays to 12% a year. But they don't care by the time you're growing at 12% a year, because by the time 400 became 200, became 100, became 50, they've raised 2 more funds, they've marked up the rest of their deals, they've made their fees. Ciao.
Here he gives a fantastic and often overlooked example of real and relatively slow growth.
Jeff Bezos grew Amazon, and I mean, this is what's so bananas. Like, none of us go back and look at the people we really want to be like. I'd like to be like that guy. He's in his 50s, he's ripped, he's rich as fuck, and he's a genius.
Yeah.
Okay? That guy basically grew at 25% a year for fucking 25 years. I'm sorry, but that's drop the mic level stuff there. That's not 400, 8%.
This sentiment is echoed in the letter. VCs are increasingly motivated by the incentives of up rounds, bigger funds and fee-based compensation. The flood of fast money has created a surfeit of these overnight practitioners with questionable sources of capital and even more questionable backgrounds. Big tech raised a total of $1.345 billion in venture capital before going public, of which $1.3 billion was Facebook alone. This means that Apple, Amazon, Microsoft and Google raised less than $45 million combined before IPO. Even on an inflation-adjusted basis, this is incredible and tells us something very important about a raft of today's startups. Speaking of something very important, before I forget, thank you very much for leaving a comment on the video just now.
False, categorically false. God, you are an asshole. You really are a jerk. Go ahead, continue.
It's safe to say 2019 was a good year for social capital. The returns in 2019 lifted their inception to date performance by more than 350 basis points. Since inception in 2011, they have compounded their money 997%, beating the S&P with dividends reinvested by more than 3 times. In 2019, they generated more than $1.7 billion in cash and cash equivalents. Chamath states that liquidity will be increasingly important over the next few years. Selling when appropriate and generating cash in a thoughtful way seems to be a prudent decision for the next several years. In 2019, they completed 2 transactions. The first was an investment of more than $500 million into Virgin Galactic, creating the first and only publicly traded commercial human spaceflight company. Chamath is tight-lipped about the second company, but describes it as an acquisition of a venture-backed company that had raised almost $100 million of traditional VC money. Oh, and another thing.
Our returns are bananas. Okay? I've made more in the last 8 years compared to the S&P than Buffett did in the first 8 years of Berkshire. Buffett did 1,000 points of alpha. I did 1,800 points of alpha. My returns are double Buffett's. And that's that's not including Bitcoin, Amazon, and the Warriors, which I did off balance sheet in my own money.
I'm the best there is. You got that?
Chamath compares the first 8 years of Social Capital to the first 8 years of Berkshire Hathaway. However, even Chamath agreed that the Berkshire Hathaway comparison was slightly misleading, as the ratio of Berkshire Hathaway's performance to the S&P 500 was around double the ratio of Social Capital's performance to the S&P 500. Nonetheless, still pretty good. For more compounded, valuable content, subscribe and like.